All right. Looks like we're live. Welcome everybody to Midas Investing Live. This is going to be our first show of earnings season. I don't know how many people who watch this video may have watched my last stream from 2 weeks ago, but I kind of laid out at the start of that stream that I kind of have a new schedule in place that I'm going to try to keep to for streams going forward. Um, I've been very irregular in my content for the last year, I know. But I'm going to try to have a little bit more regularity to my streams going forward. And part of kind of helping me to do that is I have kind of prepared a little bit of a sort of a schedule of what type of content I'll be doing on each show over a certain cycle. There's some wiggle room there, plenty of variability to kind of do some one-off shows about random things, but there's going to be a certain kind of repetitive pattern to some shows. And 2 weeks ago, the stream I did then was meant to be at basically at the start of the new quarter, or the first couple weeks into the new quarter, which July being the start of the quarter. I plan to be going over a very large overview of economic data. That's what I did 2 weeks ago, was basically just go over all the changes and tons of variables of economic data over the course of the previous 3 months. And then this stream here, as well as probably next week, and then likely a third show as well. It'll probably be like 2 to 3 shows depending on the quarter, but that's where, like I said, some wiggle room kind of comes in. But my plan is to actually try to cover earnings season a little bit more regularly as well. So that's what today's show is primarily going to be, is really just discussing the last couple weeks, which has been the first couple weeks of earnings season, and we'll go into some details that I found interesting from various earnings calls I listened to uh, across the economy. And like I said, we're going to be doing kind of a few shows of this, which kind of allows me to both cover my own companies whenever they report their earnings, which my companies, at least my current portfolio, certainly doesn't really report earnings very early on. So, like, the last couple of weeks we've had a decent amount of earnings come out, but none of my companies have reported, except for, technically speaking, Lennar has already reported for this cycle, but it's even not even in the last 2 weeks. They reported like over a month ago because they're a little bit off cycle from the rest of the uh, the season, so to speak. And then I have a handful of them that kind of come a little bit later in the season as well. So it'll probably be like the third show that I cover my own holdings, the second and third show, like I said, because it'll probably be like 2 to 3 shows covering earnings per quarter. So that's what we're going to be doing here today. I will go through a few of the companies that I found interesting, some comments I jotted down from the earnings calls, and go through some details from the presentations. I don't know how long today's stream will be because that's pretty much all we're going to be doing. And so that may not necessarily take that long. It probably depends on how many people show up with questions or comments to kind of divert my attention a little bit on that, and we'll see what happens in that regard. But right off the bat, here is my portfolio as it currently stands. There hasn't really been a whole lot of changes too much lately. I know I mentioned a couple weeks ago that I have changed my macro ETF strategy around, which I have continued to change it. It's really an evolving process. And there's probably going to be some more changes to my portfolio actually in a couple weeks. There'll probably be much more significant changes because I have shifted my allocation system around. So I'll probably be trimming certain holdings pretty significantly, as well as adding to other holdings. And some elements of my strategy has definitely been shifting around over the last, uh, really over the course of the last year. So they'll probably see some more significant changes in that regard in a couple weeks. Jeff comments, you're alive. Yeah, it's been very irregular, very, very irregular. And definitely haven't, I've had a few live shows here and there over the last few months, but I can't remember whether or not you've been able to pop into them either, because, well, if you don't stream very regularly, it kind of makes it hard for people to know when to show up that easily. But yeah, good to see you. Hope you're good as well, Jeff. So anyway, let's see, go straight to take a look at report that came out a couple days ago from FactSet. They're kind of just going over earnings as a whole, kind of top down. Definitely, it's been a pretty good quarter. It looks like overall for the S&P 500. That is where this is kind of focusing. So obviously, not necessarily relevant to a lot of people's earnings, but profit margins extraordinarily strong. That's something I keep trying to kind of point out to people when they talk about. I commented it in the Discord actually somewhat only a couple days ago. People talk about overvaluation levels of various industries or even the market as a whole. But you do have to kind of take other factors into account when you're comparing to like PE ratios or forward PE ratios on average from 10 years ago or 30 years ago to say like what are the profit margins and what and the growth rates, because those are really some of the most important factors that derive market multiples. And for example, the S&P 500 overall net profit margin, like here it shows right here, it's been kind of around 11 to 13% for the last 2 3 years. But I know if you go and look back during the 90s, it was like 8 to 9% or something like that. If I'm remembering correctly, it might even be a little bit lower than that. So there's been a huge increase in the profit margin for the S&P 500 over the last like 30 years or so, which really actually explains away a significant degree of the change in multiples. Now, obviously, what I would kind of caveat that with is that within the S&P 500, that's all the different sectors. So a huge thing driving that change in the profit margin in the S&P 500 as a whole is really the shift in the sectors allocation within the index. So like here you can see the sector level profit margins as well, showing highest profit margins in real estate, which really kind of has somewhat to do with the gap earnings nature of those profit margins, but kind of accepting out this particular kind of strange industry. And then financials themselves also kind of some strangeness to them. But infotech, 24, 25%, which obviously has become a huge portion of the index. So that's really like a big factor that drives that profit margin change, therefore the multiple change. And then there's also growth rate changes on that as well. And here they're even showing profit margin changes relative to 5 years ago, which 5 years ago isn't a huge period of time. You can see there hasn't really been that shift of time. The shift in profit margins I'm talking about is really over like a 30, 35 year period. But they also talk about growth rates as well. Oh, well, this is kind of like subsector specific. I think they had a chart in here somewhere that showed growth rates across all of them. These are the surprises. Here we go. Yeah, earnings growth across the different sectors. So within Q2, this is just Q2 specifically, so you can see like where is earnings actually growing in the last quarter specifically. Communication services very strong. I do know Netflix had a pretty significant beat, which isn't really one of the companies that I'm going to talk about particularly too much today, but I do know that they had a pretty strong quarter. I did hear some people commenting on that, so that probably drives a significant degree there. Interesting to see the huge drop in energy earnings. This is year over year for Q2, so that's compared to Q2 of last year, which I think there's been pretty sure somewhat of a downward move in oil over the course of a year in Q2. Not a huge downward move, but a downward move nonetheless. So you can pretty easily kind of see where that comes from right there. Jeff, I was getting to the live part and missed your commentary on portfolio changes. Did you do some trimming? No, I didn't do any trimming yet. I was commenting that there was probably some significant trimming coming in the future. So maybe in 2 weeks you'll see some more on that front. Oh, you trimmed some Generac? I was definitely looking at that because yeah, last night I was looking at my portfolio, kind of considering what I may or may not trim here in the near future. And Generac is definitely, one to consider. Definitely one to consider. I think I decided that in the short term I'm not going to trim them, but they are on the trimming block. So and the reason why I'm not is that I am kind of looking at their current momentum a little bit and kind of deciding that I'm going to let that run a little bit. So well, I'm going to kind of like let the market carry it in the short run. But the point is, it is over my allocation, and so it probably is on the chopping block a little bit. But I'm gonna kind of let it run a little bit and see what's up, see the reaction to earnings. Maybe after the reaction to earnings, we'll pull the trigger on that. I kind of have a similar thought about PayPal as well. Um, uh, Potentially similar thought about Hydric and struggles as well. And then all of this is really coming down to just trimming, just bringing it into allocation sizing, not because I really want to like abandon these companies in any major way. I actually am considering getting rid of my allocation in total to Fidelity National Financial, which is a lot smaller than it was in the past anyway. It's really one of my smallest holdings currently. So if I was to trim that, that would be, not a huge change. And I already trimmed most of it much earlier in the year when we were still up at higher prices. And I love the company, so it's definitely one that I would consider getting back in pretty quickly. It'll remain in the watch list nonetheless, but just kind of looking at relative, expected return opportunities. And yeah, I'm looking at that and being like, yeah, well, maybe we could trim that. And then yeah, like I said, it's kind of similar moves across the portfolio, partially because I kind of want to make room for some other ideas potentially. So like I said, we'll maybe discuss that more thoroughly in a couple weeks after I have made those moves. But definitely some thoughts in my mind. Same, feels a bit stagnant and mid in reference to PayPal. Yeah, definitely. Because like I kind of am referencing the momentum that each of these currently have in their charts as for why I'm not like trimming tomorrow as opposed to maybe in a week or two. But like Generac is definitely going strong, a lot better than PayPal in my feeling. Like in some ways they're kind of similar, but PayPal had obviously had a much further dip back down here during the kind of like February to March, April kind of time frame. So it really feels like PayPal is somewhat struggling to kind of break out a little bit. I think partially really just because of the competitiveness of the space. I think that the overall payment processing space in general, there's all sorts of questions about competition. There's the stable coin discussion about how much bank share could come into that and how much that could divert certain payment processing, not to mention other regulatory changes coming in. So, PayPal is just in a much more competitive space than Generac is, whereas there are some competitors to Generac certainly, but it's really much more of that kind of macro industry play with Generac. So, well, like I said, I still could easily trim some Generac. PayPal, I think, is a little bit of a larger cut potential for sure. So anyway, back to the kind of like sector growth stories. We're coming into the revenue line for again the year over year for Q2. You can see a little bit more of a stable picture in terms of things. Let's just kind of like focus on like what's above kind of the inflation level of growth. You can see real estate did relatively well. S&P 500 as a whole did well. Within that, financials did pretty well, and then especially well, comm services, healthcare, info technology. I do know a lot of people in the value space in our own Discord and in other places. People have really been starting to take a close look at a lot of the healthcare names. Biotech in particular has been in the doldrums for like 2 to 3 years. And then while the valuation itself is pretty good, but there's also forward expectations of growth for those companies are doing reasonably well. Here you can see over the last year in earnings flat for healthcare, and then obviously as we said a little bit above inflation for revenue growth, but then the multiples themselves have compressed dramatically. So coming back over here to like the actual results for the quarter, that was kind of really the thing I wanted to look at in this document in general. Is really just kind of looking at the beats and the misses overall. The S&P 500 for earnings, as you can see, overall pretty broadly doing very good. Whereas S&P 500 as a whole here, so about 80% of companies so far that have reported their Q2 earnings that have beat, which is, I mean, I'm pretty sure the average for the S&P 500 is like 70 to 80%. So it's not like this is some um, special quarter compared to the typical average, but then nonetheless, the quarter is doing relatively well. And kind of similar in terms of the revenues themselves, a little bit lower, I think, or no, still about 80. I thought maybe it was more like the mid 70s, but yeah, still about 80 with, yeah, comm services, info technology really being some of the really strong players. And then healthcare also revenue beating expectations. So kind of goes in line with people, like I said, looking at the healthcare space and saying, well, is there some winners to maybe pick up off the floor there, which I'll be honest, I myself haven't really been looking very much at the healthcare space. I always shy away from the biotech space in general, but I do believe there probably is some killer opportunities there. It's just that I'm just not sure how much I want to focus my time on it. Maybe I'll find one that I'll throw a tiny allocation towards, maybe, but it's definitely just makes me feel like I spent a lot of time trying to get to understand that space, and juice doesn't always feel worth the squeeze. So anyway, let's move on to some of the companies, like I said, that I wanted to discuss more thoroughly in detail. Uh, First off the bat being JP Morgan, really my favorite of the banks to listen to the earnings of, to basically kind of get an idea of the economy as a whole. It's definitely, I think, a really good bellwether to pay attention to. One, just because financials in general is a good bellwether, but JP Morgan Chase is obviously one of the biggest globally. And then also I'd like to get the comments from Jamie Dimon as well, considering I do think he's one of the better CEOs around the world as well. So always lots of good comments from him. But yeah, very, very good quarter. Return on tangible common equity, 21%. CET ratio still in a very strong position. Their RWA also in a very strong position, which those are like the kind of the risk measures. The common equity tier one capital ratio, which is basically like what portion of a certain portion of their equity relative to liabilities, and then risk weighted assets. This is kind of like looking at their assets relative to their equity, but discounting their assets based off of different risk levels for different kinds. Just two different approaches to kind of thinking about risk management from a regulatory standpoint for banks. But income for the income statement, Q2 net income of 15 billion, EPS of $5.24. So very, very good. Managed revenue, which is like managed fee income and stuff like that, 45.7 billion. So that's not including their net interest income, which is really kind of outside their control, has a lot more to do with the interest rates and stuff like that. Average loans up about 5% year over year and 3% quarter on quarter. Average deposits up about 6% year over year and 3% quarter over quarter. Remember that 6% for the deposit up year over year. That's kind of relevant to some of the comments that I have on their call, which we'll get to in a moment. Coming down, we look at the consumer and community banking, which is like consumer deposits. So getting an idea of like what is consumers doing with their money. Their deposits from Q2 24 to Q2 25 is actually down slightly. I think it was down like one or my bad, like 10 basis points if I'm remembering the percentage exactly right here. So it's a little bit in there. Overall, the deposits are up, but that means it's a larger share of deposits on the commercial side of things. So the consumer not exactly piling their deposits in, but it's also not collapsing. That's not necessarily a bad thing because consumers put their money in other places like money market funds, as well as stable coins, I guess, is the new place to stick your money going forward. So other things like that. So it's not necessarily a warning sign that it's down slightly year over year. It would be a warning sign if it was down at a much more significant degree. So coming down a little bit further to just looking at some of their outlook and stuff, expecting fiscal year 2025 net interest income of 95.5 billion, market dependent, as I said, depending on interest rates, which is relevant detail you'll see in a moment. That's roughly flat. They're basically guiding approximately flat for the rest of the year based off of net interest income, and then expecting 2025 net interest income excluding markets of 92 billion. So they adjust for some of the market dependencies within that. So the comments, the reason why I bring up the net interest income that they're bringing there, they're guiding it to be flat for the rest of the year, and that's basically based off of the expectations of the forward curve of interest rates. So like the futures based off of short-term rates relative to long-term rates from now on a spot rate versus locking in on a futures contract for 3 months from now, a year from now, or even 2 years from now, or something like that. But based on with that, if you combine that with that current deposit growth that I showed of about 6% year over year, as well as comparing that to last year's net interest income, that basically implies expectations of short-term rates coming down over the course of the rest of the year, which I just kind of want to point that out because that's consistent with what I was talking about um, couple weeks ago in terms of interest rates and insurance companies and my own thesis surrounding FG. So I basically, long story short, my expectation is that I actually have very little take too much necessarily about what's going to happen with the 10 year. My kind of base case is that to assume that the 10 year probably stays approximately where it's at as sort of a base case for the next year. It could easily come down to a significant degree, but I think it could also actually push upwards somewhat as well. So my base case is kind of about even with where it currently is. But the short term rates, the 2 year, for example, does appear to be coming down in line with the 3 month, which is in line with the Fed funds rate, which people are largely expecting there to be fund cuts sometime between now and the middle of next year. Whether that's the meeting that's coming up here in the next week, or if that's at future meetings, is a little bit hard to say. I do feel like there's maybe some potential that we actually do get a cut at this next meeting based off of just some of the political jargon kind of going around there. I haven't looked at the expectations yet. Let me look at that to see what the market's actually thinking about that. Okay, yeah, so it looks like the market doesn't think there's going to be a cut this next meeting. So maybe not. Maybe that's all just talk so far. But yeah, so either way, even if it's not this next meeting, nonetheless, I do think by the middle of next year, we will probably have at least gotten a couple more cuts to the 2 year, which means we'll be getting a widening of the difference between the 10 year and the 2 year, which is the forward curve that we're talking about. And that steepening of the curve that would create would, like I said, combined with the changes in the deposits that JP Morgan has already experienced, basically gets you that net interest income flat for the rest of the year. So this trend is basically what I'm talking about. This upward move in the difference between the 10-year and the 2-year, which you can see has been trending that way since middle of 2023. My expectation is that over the course of the next year, this will continue. Um, Beyond the next year and how much, I don't necessarily want to be make super strong, specifics on. It's just it's a direction thing. It's a direction thing. It could be 50 basis points more, which would get you to kind of like about here. But it could easily be 100 basis points to get you to kind of about here. I don't really know exactly where I think it's going to top. I just think that in the short run, it's still definitely continuing upward. And then it also probably wouldn't dramatically come back down to negative territory afterwards. It would probably stay range bound somewhere in here. And the reason why that matters is because, again, the effect this type of dynamic has on insurance companies and on FG in particular, the insurance company that I'm, up to my gills in. So, for example, if I pair FG here on a separate axis, two left scale, zoom in a little bit here, see if there's a pretty good correlation between it. When there's big spike ups, there's spike ups here. And then when it slows down on the movement upward, it tends to slow down. Obviously, there's other factors going on in a stock. They had their own kind of growth dynamics going on in FG. But nonetheless, like I said, 2 weeks ago I showed this with an insurance ETF, which goes back, a couple decades. So you can see the relationship over a broader index of companies rather than just one specific one. And also I did other adjustments on that as well. So you can show that as well. But I'm just showing it with FG because also obviously we've had the decline in FG stock here for the last couple of months. Most related, in my opinion, obviously to the issuance of stock that we had right out here. So the point is, either way, there is a divergence here. This has continued upward and this has continued downward. And this overall move increases profitability for them on a going forward basis for the company. So overall, I expect it to be a positive dynamic. Anyway, back to JP Morgan. Like I said, we kind of diverted to really explain, frankly, why I'm even listening to JP Morgan's call this closely in the first place. I mean, like I said, I like to pay attention to them for economic bellwether reasons as well. But they are closely relevant to my own holdings to a significant degree. So there's that. But anyway, as I was kind of saying, their own guidance implies that this trend would continue. However, it's worth noting that technically speaking, them implying that could also be kind of a conservatism thing. They may not be trying to specifically say that they believe that the curve is steepening is going to steepen further. It could be that that's just the more conservative thing for them to guide as well. So there is that caveat to that note that while it's in line with my thesis, it might just be because of conservatism. Um, so beyond that, Jamie Dimon also spoke to a lot of hopefulness surrounding various regulatory changes that are coming up. As I was kind of just talking about some of those regulatory ratios, there is a lot of discussion in the current administration about revising the supplementary leverage ratio, which is basically the thing that kind of replaced the defined ratio for reserve requirements that the Fed kind of got rid of around COVID timeframe, which was effectively them essentially giving up on fractional reserve banking on a defined ratio basis. And instead, they shifted it to this kind of supplementary regulatory framework around leverage ratios that they use right now. So there's been a lot of discussion over the current administration to bring some changes specifically to the supplemental leverage ratio, which should basically make it easier for banks to give out loans to a pretty significant degree. So it should be very, very bullish for the banking sector as a whole. And that's why Jamie Dimon is talking about it. But he also brings up that he hopes that they do look at things a little bit more broadly than that as well, including focusing on the CET ratios, the common equity tier ratios, which was the ratio I pointed out on their front little page there that they were talking about being here at 15% in advance of 15.1%. But they're hoping that they focus on other parts of the framework, including the CET ratio, as well as the defining of certain banks around around the globe as GSIBs, which is globally and systemically important banks, which increases certain regulatory requirements for those banks. And he also related this back to the decline in community banks, which is like a lot of the more smaller middle market banks, and basically saying like how difficult it's been for those banks to expand, which has been great for JP Morgan in terms of collecting deposit share, but it still affects the industry as a whole if those smaller companies are unable to loan, because that smaller business, while it's sort of competition for JP Morgan, it still sort of creates the lifeblood bedrock of the economy from which JP Morgan gets their own business. So while they want to do better than their competition, it's hard for them to do well if their competition is being utterly destroyed, if that makes sense. Just because of the nature of how banking works. He was hoping that to see some more expansion from the administration in that regard. And this also relates back to the expansion of fintech as well and private banking because of the a lot of these regulatory frameworks that have been making it difficult for larger banks and even more difficult for smaller banks to lend out even more over the last 10-15 years, really since the financial crisis. Is really this has been part of the reason there's been such an expansion into fintech and also into private credit, private lending, as well, is because frankly people need loans and they haven't been able to get it under the new regulatory rate frameworks over the last 15 years from major banks. So if they can change the framework around these regulatory rules, that should lighten up some of that spread of traditional banking out into the private credit space. He was also asked about their high returns on tangible common equity compared to the long-term targets. And in the comments, people were asking about if the expectation is that those are going to be their new returns on common equity going forward, and that those basically if those returns are here to stay. There was a it showed a last 2 years somewhere in here for it, maybe not. But either way, the point is, as I said showed here at the top, their current ratio is about 21%, and I believe their long-term target is 17%. So basically, the analyst is kind of asking is like, so is this going to be sustainable going forward? Are we going to be able to possibly expect 20% type returns going forward, or is there possibly like a smaller capital base and when you need to invest further into it? Because obviously, this is a ratio to your capital base. So if the returns are high, it could be that the return itself is high, or it could be the denominator is a little too low. So that's kind of what the person was asking: is do we need to invest more, or do we have higher sustainable ratios going forward? And Diamond wasn't going to argue either way about capital. He said that they kind of play it based on need, based off that, but said that the ROTC would likely be moderated by competition. He actually specifically referenced the old Bezos quote that your excess return or your margins is my opportunity, which I kind of like it when one of the best CEOs in the world is referencing one of the other best CEOs in the world. Always great. Um, but he said they don't feel like they are holding back or in any way from putting capital to work if they feel like they have an opportunity, and that these are just the returns that they are getting in this current environment. He also points out that like the nature of their business model, but kind of the split between commercial business, community business, and investment banking is designed to be a more all-weather model in as far as banking goes. And so really it's just comes down to this environment in which they kind of have it largely firing on all cylinders. Like 3 out of 4 of the weathers are great right now, when typically you expect only 1 or 2 of them to be performing great. So really he's saying that like these returns could be moderated by competition, but also just by essentially the macro environment itself. And the CFO, interesting quote to get. They frankly have given quotes like this the last few quarters in their earnings, but they said they struggle to see signs of weakness. That's literally the quote. Struggle to see signs of weakness in the consumer specifically is what they're referring to. So yes, there's like stress in the lower income brackets of the consumer, but they all point out that that's basically always true. So like if you hear people reports about, oh, people this lower income bracket is in this level of delinquencies, it's like, well, you have to kind of look at historically based off those brackets as well. They point out that basically delinquencies in pretty much all loan categories across their enterprise are within expectations. So everything looks pretty peachy keen to them, at least for now, from an economic perspective. So that'll be it for JP Morgan. How far are we? 29 minutes into the stream, so I don't know. It's a decent chunk of time just talking about JP Morgan, I guess. Maybe we won't be going too quickly, but you have a handful of other companies I want to talk about as well. Also wanted to talk a little bit about RTX, which not really a company I've talked about very much on the channel before, but I have been paying a little bit more attention to the defense space over the last couple of years, partially because of curiosity in investing in finance reasons, but admittedly, there's been geopolitical reasons to be more interested in the defense sector over the last couple of years. So it's definitely something I've kind of been keeping an eye on. And then also in terms of like people discussing about certain revamping of certain types of industrialization
here in America or in Europe or in various other places, the defense spending seems to be a pretty key aspect of that. So if you're looking at also taking a note of it being a good bellwether for that industrial spending as well, because they do a lot of defense spending, but they also do plenty of commercial spending as well. Uh, aircrafts and engine parts through their Collins Aerospace and Pratt and Whitney engines through Pratt and Whitney, and then the aerospace components with Collins Aerospace. But anyway, looking at their numbers, they actually increased their revenue guide for the full year. Um, Pretty significantly. Also, organic sales growth up as well. Adjusted EPS guide up as well. Free cash flow guide up as well. So pretty much every metric across all of their guides they increased from this quarter compared to the guide they had last quarter. And also even within the revenue guide itself, within their segments, they all the segments have increased their guides as well. So very strong expectations coming out of RTX in particular. Very interesting to look at. Some of the details here that I noted about that, that it's not just military. So because like obviously the Raytheon segment is pretty much all defense for the most part, but then Collins Aerospace and Pratt and Whitney, it's a little bit of a mixture between the two as far as that, because there's kind of commercial and aftermarket portions of their business, not just the defensive parts of it. Yeah, is here. But in like for example, Collins Aerospace here, the organic sales up 9%, adjusted sales 9%, commercial and aftermarket up 13%. So very strong. Defense up 11%. So commercial and aftermarket was actually the stronger portion of Collins Aerospace's segment. Commercial OE up 1%. So that was actually kind of the weaker segment of it. Then coming down to Pratt and Whitney, overall sales at 12%, commercial aftermarket up 19%, commercial OE up 15%, and the military flat. So despite defense being kind of a huge part of the story of why I'm even looking at the company, the commercial portion of their business is doing extraordinarily well. And that kind of flies somewhat in the face of a lot of the narrative surrounding reactions to tariffs and various foreign partners pulling back their spending, because a lot of this spending does come from overseas in their backlog. So it's like it doesn't seem to be showing up, at least on the larger players of RTX. Obviously, that may not be true for a lot of smaller companies in the the mid market cap and small cap sections of the economy. So it's not everything's the same stratified across all levels, but still very interesting to see. And then on the topic of this of tariffs, in their call, they actually made some comments specifically talking about how they're handling tariffs, which I thought was very interesting because it kind of portends how companies are handling the tariffs in general. Which it's worth noting that obviously like tariffs have gone up and then they've gone down, then they've been put on hold, and some of them have been put back on place. And really like the current tariff levels now in terms of like the total increase from where tariffs were at the end of last year versus like the maximum threatened levels on Liberation Day. Like we're currently at like a third of the change or something like that on a kind of like weighted average basis across all countries and industries. Though obviously, if you're looking at specifics, it gets much more much more specific. But the point is though is that either way, it's not the full level of tariff impact that we would expect from any kind of higher levels that we may end up at, depending on where all the discussions end up at the end of the day. But nonetheless, we do have a certain good base level of increase to discuss these effects from. As anyway, what they say is that they've been handling tariffs through a mix of pricing and other supply chain mitigation strategies. So if you kind of think about between that mix of pricing, so that means passing on pricing to their customers, and then other supply chain mitigation strategies would imply rerouting things, also changing terms with their suppliers, maybe paying off suppliers quicker to take advantage of discounts and things like that. They're not specific about what the supply chain mitigation strategies are, but the point is like the way they word it shows that it's not them eating eating the cost on a whole, which kind of goes in line with these strong growth in operating profits that we're seeing, and as well that are noticeably in line with the revenue growth, right? Revenue growth and operating profit growth are in line, if not stronger in this particular case, which shows that you're not really seeing margin compression, obviously. So obviously they're able to pass on the cost, and obviously there's other aspects of what the efficiencies from which that profitability increase come from. but nonetheless, the Raytheon certainly does not seem to be experiencing. The other detail that they mentioned there, the combo of lowered tariff rates and or pauses caused them to almost halve their expected impact. So I think if I remember from the comments, their original when the tariffs were originally put out, they put out a statement basically like many companies did, saying, "Oh well, this is what we could expect for maybe an impact from tariffs." They said something like $900 million of potential impact from tariffs expected on gross margins, I believe it was, and then they've lowered that now to 500 million. So they've almost cut that in half. And like I said, that's has somewhat to do with the lower tariff rate and or pauses. So depending on where the terminal effects are, they could expect like potentially up to 400 to 500 million dollars of more impact to be put on front of that. And then they also spoke optimistically about making use of new tax changes that came with the one big beautiful bill that recently passed, which includes and this is something I haven't seen a lot of as or at least not enough investors, especially retail investors, discussing, is some of those tax changes that could be pretty beneficial for some of their companies over the next year, which that specifically has to do with the continued use of capex and R&D immediate expensing. So basically, usually when you like say buy a factory, you spend $100 billion in your factory, you're going to have a useful life, say 20 years, which means maybe you're going to be depreciating about 5 billion of that off of your income statement each year going forward, which is a cost. It lowers your net income, but in a cash flow sense, it doesn't affect anything. Your cash flow is you spent the $100 billion up front. So the reason why this is beneficial is that you get to save on taxable income that $5,000. So $5,000 is lowered from your taxable income. If we assume the company has, say, a 20% effective or marginal tax rate, then that would save them about $1 billion taxes each year for those 20 years, right? So buy $100 billion factory, save $1 billion on taxes for 20 years each year. That's basically how it traditionally works. But this is something they did during the first Trump administration, is that that tax bill he passed way back when, is that they allowed for like the next year or two in the tax code. They made it so that if you bought a factory, you were allowed to expense the whole thing in 1 year, which means that you essentially get that $20 billion. It's the same total tax savings. It doesn't change the amount of tax savings you get, but it changes the timing of the tax savings. Rather than getting 1 billion per year each year for 20 years, you can get all 20 billion of it up front in the first year. And time value of money, that means that it's more valuable to you. So you would much rather save taxes next year than save taxes each year for the next 10 years if it's the same dollar amount. So basically, a long way to explain how that works. They basically pass a detail in the one big beautiful bill to allow for that type of expensing again next year for capex, but they also did it for R&D expenses done in the United States. So there, which I'm pretty sure that wasn't a detail in the time that they had done from 7 years ago when he had done his previous tax bill in first term. I'm pretty sure R&D wasn't included in that, so this was something that was lobbied actually in the last couple of years by a lot of major companies. But that I think is something people are underestimating the effect of on many different fronts. Now, I actually brought up obviously the biotech space being in the doldrums in the last couple of years, but I do think that that change in the tax bill is probably a big tailwind for them as well, because that means any R&D expenses done here in the United States by those biotech firms, that's going to be immediate tax savings for them. So for R&D expenses that they might otherwise have already been doing. And so anyway, like I said, I brought that up in the context of RTX because they brought it up in their comments. They were very much looking forward to taking advantage of the capex and R&D expensing in the next year. And they said that they would be balancing their current existing cash flow and R&D or return on equity dynamics with the opportunity for larger spending next year. A large way to say that they're already expecting to be spending a ton of money next year. Great that they're going to get the savings on the money they're already expecting to spend, but they will reevaluate and decide whether or not they want to spend more money next year in order to save even more. But that's Raytheon specifically, like I said. But you got to think about that dynamic for all of the tech companies that have been spending capex like mad and also spend R&D like mad, and also the biotech firms, like I said, that have been in the doldrums that spend R&D like mad. They don't really spend capex like mad, but they do spend R&D like and like I said, it's in the United States. So depending on where, if a lot of these tech companies or biotech firms have developers or researchers in Europe or in Asia in various places, well, then that's not going to be applicable, or maybe they'll have to rearrange things to make it applicable for them. But the point is, yeah, that should be a pretty interesting boon. And like I said, I think that is going to be a huge factor for a lot of companies' um, performance over the next year or two. I think a lot of investors are probably not thinking through um, whether or not their companies are going to be getting that kind of benefit or not, or companies that they might otherwise wish were their companies that could be getting that benefit, and if they understood the increase in tax savings that those companies are going to receive, that could change how they see some of the valuations surrounding those companies, perhaps. So something to keep in mind. Something to keep in mind. That's one of the details in the one big beautiful bill, which people talk about how it's increasing tax breaks or and not bringing enough revenue in various ways. And I argued a couple of weeks ago that I think people are also underestimating the tariff revenue itself that is likely to be pulled in. But also, nonetheless, that is this tax break on the capital spending is one of those avenues by which they are technically allowing for further tax breaks. But hey, us as investors, we should love that. It's like maybe as a citizen you don't like that tax break, but as an investor, when you have your investor hat on, you should like that tax rate. So compartmentalize your feelings on those subjects. So anyway, what was I had? Oh yeah, okay. No, that was pretty much most of everything I had to say really about Raytheon. The only other kind of thing I wanted to kind of point out about Raytheon's earnings, which was interesting in and of itself. I mean, pull up the stock, they've been just on a tear, on a tear. Basically, since the defense theme kind of came into play over the last couple of years, just exploded. Just pretty crazy for such a stalwart defense stock, right? But this, their overall beats on revenue, 4 to 5% on beat on revenue, 8% beat on earnings, and then comparing that with and also obviously the positive reaction you can see in the stock that they had, but then compare that with Lockheed Martin, which reported the same day. I didn't listen to the call. I did look a little bit at their presentation, so obviously we didn't discuss them here today, so that's just kind of its own thing. But missed on revenue a couple percentage points, and then a huge miss on the quarterly earnings. So I imagine maybe there's like a one-time expense in there that's making it be that devastating. I'm not sure. Like I said, I didn't really look into the details of it, but very interesting to see because I would have almost consumed that there would be that it would be consistent across all of the major military suppliers. I would kind of assume that they would kind of be in line with each other somewhat to an extent for this. So very interesting to see. And I mean, let's look at them next to each other over the course of that overall trend. I mean, zooming back to, like I said, that spot here, kind of late 2023, that we've been kind of moving since then. Obviously, RTX has really kind of outperformed dramatically since then. So I guess maybe it's really just another reaction in the long line of sadness on that front. But interesting, interesting. Which maybe that means LMT's the deal right now. But I don't know. Like I said, I didn't look as closely at their earnings because frankly I was more interested in RTX. So, but I don't know. Maybe I'll look closer at them this week. Maybe I will give you some further feedback on that in a couple weeks at our next discussion. Um, so all right. So moving on from RTX, let me get some of these things up here. Google. Talk a little bit about Google. I don't really talk too much about Google oftentimes or AI in general, but what with AI being a big theme, definitely trying to pay a little bit close attention. You'll see kind of the specifics of the reasons why I'm paying attention to Google and AI in general. I definitely think, I mean, obviously the market agrees with this sentiment based off of how the market's been treating Google this year compared to all the other Mag 7 or other major AI names. Alphabet is, yeah, let's just compare them with um, Soft, Meta, year to date. Yeah, so obviously, yeah, doing pretty poor compared to them, and that's with the argument of Microsoft kind of being their primary competitor in the cloud operations, and then Meta being their primary competitor in advertising, which is still not exactly apples for apples in either of those categories exactly, but nonetheless, that's what I'm going to call their kind of like top large market cap competitors in this sense. You see significant underperformance in that regard. They've they're at least positive for the year, but those guys have actually had a positive year despite all the negativity there. But ignoring that within it, um, see that they did in fact have decent enough quarter, beating on revenue by 2 to 3%, and beating on earnings by 5 to 6%. And within that itself, that's a 14% year over year change for the Q2 revenues. And then EPS, that's a 22% increase. So, they beat on both of those factors, which means that they were already expecting like 12% increase in revenues and like, what is that, 15% increase in EPS. So very, very strong despite all the potential negativity about whether or not a huge portion of their search revenues is essentially going to be leached off to all of the LLM discussion, which is why I basically am listening to their call and paying attention, because I am curious myself to see what kind of effect that is going to have. Their whole model is basically about people searching, going to the search bar, searching through, and then ads being fed to them as they are either on the sides of the search or through click throughs. And the big question is, well, if you're going to an LLM and you're just having a discussion with a chatbot, is that really going to be able to drive advertising revenue in the same way? Jeff's reminding me to holler at folks to like and subscribe. Yes, thank you, Jeff. Please do. Please do like the stream and subscribe to the channel, hit the notification bell and all that if you're enjoying the content I do here. Also consider joining the free Discord. The link is down in the is pinned in the cat in the chat and in the description below. Come join, be part of our little community where we discuss all sorts of things related to the stuff I'm talking about here, portfolio management, things going on in the economy, all sorts of stuff, our favorite industries, all sorts of stuff. Come and join our little community there. But yeah, do like the stream. Do like the stream. That way we can help attract more people to the future shows as well. But coming back to the alphabet here, looking in more specifically down to there. I don't have it in there. My bad. Coming in to take a look at more specifically within the subsections here, you can see that Google search itself is still up pretty significantly on the quarter, going from 48 billion to 54 billion for the Q2 revenues. So search is doing really, really well. YouTube ads doing really well. Google network has declined a little bit, but I'm actually not 100% sure of all the pieces that go into the Google network versus Google ads and search. Obviously, the lion's share of the advertising comes from Google search. And then YouTube has been kind of its own little animal that kind of is doing its own little thing, which in many ways is like I kind of wish they would spin off YouTube so I could invest in that myself, like separately, like that and Waymo. It's like give me the YouTube Waymo company and like get rid of everything else. Good. I mean, obviously their cloud services are good, but it does have these big questions about what is going to be the balancing act between the search and the change in the search model having to do with LLMs. But nonetheless, as you can see, it's still up pretty significantly. On the quarter, and also within Google services, you can see the operating income also still up pretty significantly. Let's see what was some of the ad. So over the course of the last 6 months, like they've released their AI overviews within search. So like if you do a search now, it has a little box at the top where it gives you a little AI overview that you can continue the conversation with. So you can kind of gives you an alternative. You can do like a traditional search, and it basically gives you the opportunity to just kind of use the traditional approach or to use the little AI overview at the top that kind of lets you, it's like a way to kind of like try to sidestep you into the AI usage. And then beyond that, they've also introduced their AI mode in search, which they launched in the US and India over the last quarter. And then obviously they have their other various dedicated AI tools, including Gemini and uh, uh, the DeepMind research and all various other tools that they have for developers themselves to develop LLM tools themselves. And that's like where I think a lot of their arguments going to come from. You'll see from some of the comments I have about that they seem to be arguing that Google search is going to at least be able to maintain itself, and that really they're going to benefit from AI based off of people using Google Cloud more because of AI, including the companies that are developing the AIs themselves. Jeff, I kind of wish they'd spin off Chrome and force the world to rationalize the value, but YouTube would be nice too. I think when they're all tucked in a conglomerate, the market never fully cares. Yeah, I mean that's just conglomerate 101. Obviously, is that yeah you can't really assess both the industry risks of specific segments, but then also the kind of like idiosyncratic company risk, because all the idiosyncratic risks of each segment get kind of bundled together on the top corporate level. And so it's hard to tell whenever you have an idiosyncratic problem with the company, really like which segment is the one that's truly sourcing the problem. And like for example, like one thing, uh, like I did kind of like to kind of question that for that same issue is that like I'm looking at this and saying, oh, okay, Google Services operating income is doing very very strong here. Google Cloud operating income is also doing very strong here, which seems to show that whatever increased usage of their cloud infrastructure has not been a drain on profitability for them, at least in the short run. But then the big question you have to ask about it is then, like for example, these alphabet level activities that they show right here, which you can see the note. In addition to these costs included in alphabet level activities, hedging gains, blah 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 blah. Um, um, never mind. It isn't actually in this note. I'm pretty sure it was there's another note. There was another note somewhere else that basically implied that they are putting a lot of enterprise level AI research into this bucket right here. So like the big question you have to say is that okay, well that's fair, but then like look at like the changeover in the alpha level activities. Like is some of these costs really belong to the Google Cloud or to the Google Services costs? Does that make the increase in the operating income from this Q2 to this Q2 maybe not as good as it appears? So like right here it goes from 1.2 billion to 2.8 billion, right? Um, to 2.8 billion. But here you see it goes from 2.3 billion to 3.4 billion. So we have like a 1.1 billion increase in the alphabet level activities. And then the question is like, well, does that deserve to be put off into some of the costs that are here? Like here we have an increase of what is that? 1.6 billion. And then here we have an increase of um, 3.4 billion or so. So 3.4 billion in Google services, but then we have 1.1 here. Maybe it's a little bit less, but I would also argue that 1.1 billion isn't really that big a difference. So like for example, if this was more like 6 billion, then that would be more of like a 3 billion difference, and that could cover almost the entire profitability increase that you had in this one segment. And that's really the example I'm trying to show. Frankly, like these numbers actually basically show that that's not really a problem at all. The problem would be the reason why I pointed out is that you do have to kind of be cognizant of them hiding their costs basically in these like top level segments that basically can make it seem like the AI is having higher returns on invested capital than it really is achieving, at least at this point in its development. So anyway, getting back to some of the notes I had on their call. Uh, duh, 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 duh. Yeah, so as I was kind of saying before, with the main question about being about their search and ad model and how that might change with people relying on LLMs, they point out that embedded within the 12% increase in the search that revenues that they had here, so they have 12% increase in search revenues, but they also point out that if you look in the 10Q, they had a 4% increase in their pay click growth, which is basically a metric that takes the total clicks into account and then references what percentage of those clicks are resulting in actual profitability for both the advertisers and then the advertising spend coming back to Google as a whole. So in a sense, you can kind of look at that as almost like units versus price increase in terms of thinking about revenue increase, right? Like you have a retailer, the revenues increase. Well, what percentage of that was them raising prices versus what percentage of that was them selling more products? So in Google search, they had 12% increase in revenue, and about 4% of that is them having payable clicks that were increased more, and then maybe about another 7 to 8% more would have been from pricing increase, which is good that you have it on both ends. Like one, it shows that they're still getting organic growth in the overall click throughs for their search revenues as a whole, despite the LLMs being out there. And they still have strong pricing power too. So that's the other thing too, is like you wouldn't want all 12% of it to be pricing because that means that they wouldn't be organically growing. But it is good to see a healthy percentage of it still be pricing because that shows that they still have competitive pricing power as well. So either way, I thought that was a pretty good way to kind of argue that. I mean, the, basically what their answer to that question is that they're not seeing it yet, right? Like that's not saying that that their search model won't be in jeopardy in the future, but they're basically pointing out that at least in the last quarter or two, their organic growth within the actual KPIs of search itself is still quite strong. But they also point out that that metric, the pay click metric, is pretty volatile quarter to quarter due to changes in advertiser spending, which makes sense. So it is something that like, yeah, that's true for Q2, but you do probably want to look at that on a quarter to quarter to quarter basis to really see what the overall trend is. And then they also point to the click through rates also trending well with the last few years, if not trending slightly upward, showing that it's also still a pretty efficient usage of spend dollars for those advertisers as well. Then, like one of the last things I kind of wanted to point out was a question that was asked in their call about their massive capex spend in the AI race, and like kind of relating it to all the other companies that have been spending massive amounts of capex dollars to basically secure as much compute access as they can, which is the fancy way of saying buying chips like mad to be able to put them to work, because the argument is that they need them now. Because if they don't get them now, they'll be so far behind that getting them later basically makes it worthless. And they point. So then the analyst then basically is asking about profitability and return on investment on that capex, and saying, well, are we really going to see the turnaround on that? And then they point to their cloud churn rates being at their historic lows as providing a quick turnaround than it seems. And they didn't actually say what the cloud churn rates were, and I didn't really go dig through all their 10 Qs to go find out. I just kind of was going to trust it on the comment, but they say that the churn rate on their cloud subscribers is basically at historic lows, and that you would see that turning around faster if the capex spend was effectively um, not resulting in good ROI. So that's at least, like I said, that's another kind of answer of saying not yet. That's still another answer that doesn't really give you a definitive answer about the future, but it at least gives you something to look at going forward to get an answer about that. So maybe 2 quarters from now, 3 quarters from now, I'll take a look at their churn rate in higher detail and see whether we have seen a deterioration in that or not. So that's pretty much all I have to say about Alphabet, Google. Like I said, my focus on listening to their call really was kind of because I was curious to get answers myself about the AI question, and how it relates to advertising dollars, especially since that's basically all of Google's business for the most part is advertising dollars related to search. And if people are no longer going to be searching and clicking through in the same way, then what does that do to advertising dollars? But for the time being, uh, it it's just not showing up at all. Not showing up at all. If anything, their fundamental momentum continues going forward. So anyway, as you can see, I did pop up here. This may give the hint of the next company I was going to talk about, which happens to be DHI, DR Horton, um, the major home builder, which is pretty relevant for my own portfolio, considering I have a pretty significant position in Lennar. So that's definitely why it's a major company in focus for me, but also just because housing, housing being a major economically sensitive segment of business. So very, very important for understanding the economy as a whole as well. But yeah, let's see, get to my notes here. Overall, let's see, they raised their full year revenue. They also they raised their full year revenue guide for 2025, and then they also raised their home closure, the closings, not closure, the home closings expected for the full year, and they also increased their share repurchase dollar spend range as well. So very, very good raising and guidance for them. And then the market definitely rewarded them on the day pretty solidly with a nice little pop. I think it was like an 8% pop immediately, and then it moved up to like 13 or 14% or so by the end of the day. And then you can see, well, it gave back about half of that total 13, 14, 15, or whatever it is percent back down to basically around the pop or so. Either way, still a solid pop on net. You can see, it's like going back. They were still at highest prices since January, so good for them in that regard. And other home builders did get a little bit of a pop as well, but definitely not as much. Like look back at NAR, they got a little bit of a pop on the day. I mean, as I mentioned, they reported a month ago, so they're kind of off cycle. So they report a month before most companies start reporting their earnings, which means that their Q2 is, in fact, I'm pretty sure they call it their Q3 actually, is really more kind of like on Q1. So it's like they technically report early, but in a sense, I kind of treat them like they report late because of the actual lining up of the actual fundamentals with the rest of the companies. So either way, the point is I looked at the pop in DHI and these strong fundamentals as probably being optimistic for this upcoming quarter that will be reported for Lennar in about 2 months or so. So that we'll see how well that plays out. Obviously, it could be company specific, so we'll see about that. But I'm looking at that as a good optimistic sign. Not to mention, there's been other aspects of the housing market. I'm looking at all sorts of metrics in the housing market pretty much every other day. And there's lots of signs, in my opinion, that we are essentially bottoming, or that really that we essentially bottomed kind of near the end of last year. Really, it's like the housing market. It seems like we're really kind of reaching the worst stages of everything, kind of like starting towards the end of last year, and then that bottoming process is really just taking almost like 2 to 3 quarters probably to actually achieve, which is therefore kind of funny that the big drop in the housing stocks came here really at that same time, because in my opinion the fundamentals are bottoming kind of at the same in like the same way and at the same time as at least Lennar stock as right here is bottoming. Obviously I have Lennar up right here, but let's go back to DHI. We can see basically kind of the same trajectory. Or we can look at ITB, which is the home construction ETF. You can see it's kind of the same overall pattern. But either way, I'm expecting that by the home building season of next year, which is like the middle of the year next year, I expect to probably be a little bit stronger. And then that obviously is also going to depend a lot on the interest rate discussion as well, which like I kind of already gave my expectations about interest rates, which is that I expect short-term rates to very likely come down to at least a moderate degree over the course of the next year. It could be a moderate amount, but it could also be a pretty significant amount over the next year. But as far as long-term rates, I don't necessarily have a strong take on that. Like there's strong arguments in my opinion for long-term rates to also come down at least to a moderate degree. But there's also some solid cases for why they would move upward as well. So, and I can see a scenario where short-term rates come down significantly and long-term rates go up slightly, which would be an even further exasperation on that yield curve steepening dynamic as I was talking about. But how that works for home builders, like why that's relevant for home builders, is well, frankly, their business is much more focused on the long end of the curve. So, that's the thing that's been painful for home builders is that this is still up here. Even so, you can look at the 2 year rate, and like the 2 year rate peaked almost 2 years ago. Like we've technically been coming down in the 2 year rate for almost 2 years now. It just doesn't feel like that because we're way up here and it hasn't come down very quickly. It's coming down very, very moderately and slowly, but it technically peaked almost 2 years ago. And I mean, the 10 year rate technically also peaked around the same time. But you can see that like that trend since then has just not been the same. It's been much more of a kind of a channel range bound kind of trend versus a much more consistent lower highs kind of trend, right? So I'm charting and all that, but on interest rates no less. But the point is you can see it's like there's good reason to believe that that would continue, and if that continues that way, well then home building isn't going to get very much reprieve in that regard. I know the administration really is hoping to be able to put down long term rates as well, but frankly, politics just doesn't have that kind of control over long term rates. It has some small marginal control over long term rates, like if the Fed wants to just go buy up all the 10 year treasuries out there and print dollars to do it, well then they can force the 10 year treasury down at least short term. But it is a very short term kind of manipulation of long term rates that they can do. They can't really like very very strongly influence them, at least not without like making certain significant like regulatory changes, which some people argue that they might do actually over the next year or two in the administration. But at least in the short term foreseeable future, those options aren't really on the table. So anyway, getting back to DHI though, it's kind of a diversion from that discussion. The reason why I bring that up is that I do think that uh, with that interest rate kind of discussion in place, they are still expecting to be able to, like I said, increase the home closures that they had previously guided for from last quarter. So they're expecting higher levels of revenues, higher levels of closures, and being able to therefore have more profits to them buy back their shares with. Um, and one interesting detail they point to in their call, and this kind of gets back to I think a lot of the negativity surrounding home builders over the last quarter. There was been I can't even tell you how many news headlines I've seen talking about home builders and issues with demand in the home building sector, and people talking about prices dropping, incentives on the home builders. That's been like one of the kind of narratives going around the market, is that the incentives are so high on home builders that it's basically going to crush their gross margins to a significant degree. But DHI actually comments on that pretty significantly. They say that they expect incentives to remain high through the remainder of the calendar year, and if not increase somewhat. And to understand, like an incentive, a home builder incentive is basically like a discount on the price. Basically, what they're doing is they're not lowering the sticker price, but they're giving you a certain $10,000, $20,000, $50,000 kind of incentive against the home price to essentially give you a discount. It's like so they don't have to actually get rid of that base pricing. and it just gives like the one individual customer at this moment in time that discount. And they're pointing out that this strategy is being used kind of across the home building sector. In fact, Pulte Homes (PHM) reported basically at the same time as DHI, and they kind of implied that PHM is using basically the same strategy. Um, that they're basically not doing price cuts really anywhere, and for the most part, unless it's in communities that are basically largely completed and the inventory has significantly started to age. And that for the most part, that's a very select few amount of communities. And then beyond that, they're mostly just sticking to incentives. Now, this strategy is probably more common at the larger end of the home builder industry. So these larger players are probably going to be more in a position to actually try to use that strategy than a lot of the smaller home builders. So that's one thing to kind of keep in mind with this, is that there is going to be other smaller home builders that are probably going to be much quicker to actually just lower their base price, because they just will have to in order to make sales, because their gross margins actually would be crushed by the incentives probably. But nonetheless, a much larger segment of the market is driven marginally by these larger home builders in general. So another caller also points out, another analyst on the call points out the slight uptick in the LTVs for the purchasers of their home builders over the last couple quarters. LTVs, which is loan to value. So basically, like, what is the size of the mortgage relative to the purchase price of the mortgage? And so an uptick in LTVs means that the purchasers are taking on a slightly more leverage over time. Now, like they said, it's a slight uptick in LTVs, but nonetheless, the analyst was said, wanting to get the details on that. Good for him, smart analyst who's taking even slight upticks in LTVs to be serious, and not to poo poo it and act like it's not a big deal. But they explain it away through a higher mix of FHA mortgages, Federal Housing Administration mortgages, which makes sense. That is reflected in their numbers. And FHA is basically like the Federal Housing Administration, which gives out subsidized lower mortgage rates, that are below a lot of the kind of like the typical average of mortgage rates. Like, go to pull up the mortgage rate, actually it's going to be relevant here. So like here, the 30-year fixed rate mortgage average in the United States, currently at 6.74% in the last week or so. But this is an average, right? 6.74%. So it's going to be a wide range. It's probably going to vary between people. Probably going to be people getting 5%, and there's probably going to be people getting close to 10%. But an average of 6.75% is kind of where it's currently at. But they also point out that part of the reason that there's been a little bit of a switch in the mix towards those FHA loans is partially because of the rate buy down opportunities that DHI and other home builders have other larger home builders have been doing as well, which is another thing I've been seeing in some of those headlines where people have been talking about home builders basically like arguing that their reports were about to collapse because of cancellation rates and rate buy downs. Basically, what the home builders are doing is that they're basically looking at their customers, and saying, hey, you can go out and get a mortgage. If you go out and get a mortgage and you get a 6.74% mortgage, but you get it at a certain under the credit conditions, the right credit score, the right LTV, the right payment size, the right debt to income ratios, and like all the appropriate metrics that makes it so that the FHA is actually willing to issue that loan. Then what they're willing to do is they're willing to buy down that 6.74%, or that's just an example we're saying here that maybe they have 6.74%, but they're willing to buy that 6.74% down and give the customer, DHI has been offering specifically a 3.99% rate. So that's, way down here, a much lower rate. Basically saying that you can go out there, go get a mortgage, don't worry about what rate it is, just as long as you qualify for an FHA loan, then we will give you the opportunity to have this lower rate. It's just kind of another way to lower the cost, kind of push people in the door. And like I said, this has been a narrative going around markets that, oh, this is going to be devastating to their profitability, and stuff like that. But it shows up in the numbers that hasn't been the case. They obviously, as I said, they have raised their guide, raised their closure guides, and they expect to be able to do that. They also say that the average rate in their backlog is currently about 5%, a little over 5%, they say, which implies a pretty large mix of those 3.99% and say like a 4, or say like a 6%, right? Because if you have like say a 4%, 50% of your book is at 4%, and then you have 50% of your book at 6%, well, then the average is going to be about 5%. And they said it's a little over 5%. So really, it's probably like maybe if you could say 50% of their book at that 3.99%, then maybe they have another 50% of their book at like 6.5 or 6.25%, which is a little bit lower than the current average mortgage rate, right? So that means that like the people who aren't getting the buy down opportunity are probably closer to this range. And like I said, like this is an average, so it's really a range. Um, so you can see like their customers, that the implication there is that they are better customers with higher credit scores, lower debt to income ratios, and can get lower mortgage rates even before the rate buy downs. So good for DHI, I guess. They were also asked in the call uh, about tariff effects and labor effects with the changes in the new administration, and they didn't really say much about tariffs, which I kind of was a little sad about because honestly, I would have preferred more of a comment on the on effects to costs due to tariffs. But they did comment on the labor part. They mentioned that the labor is plentiful, basically plenty of contract traders hungry for work from their perspective, so they don't seem to be concerned about any changes in labor market dynamics, currently speaking. And then, like I said, they didn't really make any specific comments about the tariffs. However, you can kind of take some implications about the tariffs based off of some of those other things that they'd already talked about. And specifically, that's to say that if I go, I kind of talked about it already, but I didn't show it explicitly. But I'm pretty sure they have a there's a slide in here somewhere. Maybe not. Maybe I'm fooling myself. I thought they had a slide here somewhere that shows gross margins recent. Didn't they? Then the other talking maybe it was piece. I don't know. Maybe I don't remember at all what I was at, but I swear that they had showed might have been somewhere else, but I'm pretty sure their gross margin stayed flat this quarter with last quarter specifically. That's the detail I was gonna kind of point out. And if you take the implication of a flat gross margin this quarter, oh, here it is. My bad. Knew it was somewhere. Here it is. 23.5%, or no, not quarter. This is year over year. My bad. Um, Fiscal year 23, 23.5% gross margin, fiscal 24, 23.5 gross margin. And then in the quarter, they also had 23.5% gross margin. If you take a flat gross margin and have increased sales incentives, which we already talked about, then the implication there is that you haven't been experiencing margin compression due to tariff effects. In fact, if anything, you've had efficiency gains in your gross margins to be able to achieve that flat gross margin overall. And then also, pointing out this, they show their 10-year median gross margin being 21.6%, showing that they actually have a little bit of wiggle room to maybe give on that front. So at least for DHI specifically, they seem to be currently handling the tariff dynamic reasonably well. It is worth noting that home builders specifically are in a position to not be experiencing as much of the tariff effects based off of the kind of lowering of rates and the pauses and all of that, compared to, like, for example, RTX. Like I had mentioned that with RTX, I was saying that like RTX is probably only experiencing about 1/3 of the total increase in tariff effects compared to what it would have been at the end of last year, relative to like kind of the peak levels implied from Liberation Day. Well, that was an estimate on my part, but if I was to say it's 1/3 for RTX, it's probably more like 1/5, 1/6 for DHI, which is a long way to say that we that you can't necessarily read too much into it. Like I'm technically arguing that, oh yeah, you can say, and you can see in the numbers and the fact that they had those high incentives, that implies that there's basically no tariff effect in their numbers currently right now. But I wouldn't take from that the implication that that means that they have been able to pass on those costs to their suppliers or to the customers, which is what I did say about RTX. And the reason why is because I just don't think they're experiencing the effects yet, right? Like they're just not having it yet. They've been able to completely ignore it so far. So we'll see going on that going forward. So let's see, that's all I had to say about DHI. I think I had at least one other comment. No, no, yeah, that's pretty much all I had to say about DHI. So yeah, like I said, I'm focused on home building largely because I have my own pretty significant position in Lennar. So really, I'm very curious to see like what these numbers portend about Lennar's earnings. Technically, Lennar reported the same quarter already a month ago, but that quarter is kind of offset in a weird way that really makes it more closer to the previous quarter before that. So really, I do think that these earnings for DHI speaks more to Lennar's next quarter than it does to Lennar's previous quarter. So looking forward to Lennar's earnings based on that. Uh, so okay, let's see. Next on the agenda of companies to kind of discuss things about where are we at in our timing. We're at an hour and 15 minutes. Okay, so we're doing pretty good. This is a pretty robust show. I know I kind of said at the start of the stream I wasn't sure how long it was going to be because I kind of feared in my head, which I sometimes do this often when I'm kind of preparing these live streams. I kind of fear that I'm gonna like run out of things to talk about, and so like I almost like want to pack a show full of things, and then sometimes I don't even get to all of the things. But I was kind of worried that I would almost just talk for like 5 minutes for each company, and then I would just be done with in like 30 minutes, and then like 15 minutes I spoke about other stuff, and then I'd have like less than an hour of a show. But we're doing good here. We're doing good here. We're like I said, we're well over an hour already, and I technically have two more companies to talk about. Though the last one, I think I really only have a couple comments really to say. I don't have a million things to say about that. But Blackstone. Blackstone is the next one we're going to talk about here. Um, very relevant for um, my own positions, and also just kind of like keeping a close eye on it for various macroeconomic reasons as well. Blackstone being one of the largest and most major private equity firms in the United States, and they have a particular focus on real estate. So Blackstone's definitely one to pay attention to get an idea of like kind of what's going on in the real estate in terms of that discussion about whether or not we are kind of bottoming in the kind of macro environment for real estate broadly. Now, I was kind of focused on home building a second ago, which is more specific within real estate, and then Blackstone is has a little bit more of a larger focus on commercial. And commercial probably did bottom sooner than housing did. So like that's kind of good for them in that regard. But overall, doing pretty well and on fire. In fact, like let's look at their stock. See, do pretty well. And this kind of see what exactly what I was talking about is like they private equity was kind of already going into some negativity a little bit, kind of similar to home builders in that regard, prior to Liberation Day even happening. And then obviously Liberation Day had its own thing, but it was kind of already having a little bit of a retracement from admittedly a pretty significant run up over the last couple of years. It's like pretty insane. They're more than tripled prior to COVID. That's pretty crazy for private equity. Um, but anyway, the reason why it's especially relevant to me is because Blackstone manages the vast majority of FG's assets under management. So I pay attention as much as I can to things going on in Blackstone to get an idea of what's happening with FG on kind of like a micro and macro level. So within that, they did very, very well. They had a very strong, outstanding quarter that seems to portend pretty good things, I would say, overall. Pretty strong growth. Pretty strong growth kind of generally across the board. Total assets under management of $1.2 trillion, almost 900 billion in fee earning assets under management, as well as almost 500 billion in perpetual capital assets under management. In the quarter, they had $52 billion in inflows and over 200 billion over the last trailing 12 months. So that was one of the big discussions about private equity is concerns about expected outflows, people wanting their capital back who invested in the funds, and then that not being matched up with a lot of the actual investment funds having their assets essentially pushed off when they're going to be able to get the realizations. That's basically how they talk about it. Is that there's inflows, which is money coming into the company that needs to be put out, needs to actually be invested out there, and then deployment is how much money did they actually invest into new investments for those assets under management. And then realizations is basically how much of those investments have come back in the form of cash back to the company that can then be distributed to their various partners, and then whatever's left after the partners gets turned into the actual earnings of the company, the publicly traded company that we're looking at here, right? That's the reason why this matters is because a lot of people have been concerned about inflows potentially starting to turn into outflows if the realizations themselves slow down too dramatically. And realizations have slowed down pretty dramatically over the last quarter, but nonetheless, inflows have been coming in pretty strong. Very strong inflows and deployment over the last quarter and trailing 12 months. Realizations still a bit on the weaker side, but still coming in nonetheless. And then also, it's worth noting that private credit and insurance are taking the lion's share across the board within that. So if we come down here, um, take a look at this kind of like overall table here showing what's happening with those different categories, the inflows here on the Q2 level, as well as the trailing 12 months, and then capital deployed for in the same way, and realizations. And they have it split up into the different segments of real estate, private equity, credit and insurance, and then multi-asset investing. And you can see that this is just inflow. So over the last 12 months, the Blackstone as a whole, like I said before, has had over $200 billion of new capital coming into the company. Some of that inflow could be previous outflow, is kind of on a netted basis, but $200 billion coming into the company to be deployed over the last 12 months. And then over $100 billion of that is just in the credit and insurance segment space. So huge portion of their business to credit insurance, which this is the portion that's most relevant to me, given that this is where FT's business essentially lies. And then you can see it's also pretty much the lion's share on just within the Q2 level too. $52 billion brought in on the quarter, and over half of that coming in from credit insurance. And then you can see that that kind of like lion's share aspect is pretty consistent generally across the board, maybe not to the same extreme level. So you like here on capital deployed, you can see it's a little bit less than half on a trailing 12-month basis, and a little bit less than half on a Q2 basis. And then realizations, it's a little bit less than half as well. So more money is coming into credit and insurance than has been deployed and has been realized. But I do think that is somewhat of a function of the rate environment and them probably waiting for um, lower rate environments to be able to realize on their investments, and higher rate environments to be able to deploy on their investments. That's kind of the nature of the business. It's like the yields come up here, you want to deploy capital. The yields come down here, you want to realize capital. That's kind of how it works. And it's true that inflows tend to happen when you're on the upper end of the scale more so than on the lower end of the scale. However, fast upward movements in the rate itself can decrease that, which is why people have been worried about inflows, because rates came up. So therefore, people were worried about the high level of inflows. But once the rates leveled off, then people stop worrying about the inflows, and at that point, they start just worrying about the realization, because you need rates to come down in order to get the realization, right? That's kind of like the dynamic there as far as like the interest rate environment and how that defines whether inflows are happening, capital is being deployed, or realizations are happening. It's like they sort of need all three categories to remain healthy, but you kind of need different interest rate dynamics to be happening in order to incentivize higher amounts of movements in each of those areas. Anyway, focusing though in, like I said, on credit insurance, very, very happy to see that this is a strong base, because what that means is more capital is coming into that needs to be deployed here, and that need to deploy turns into assets for FG. FG has their own business coming in, and then that turns into assets for them to be able to deploy. And then the realizations, frankly, I don't really worry about as much. Like, you want it to at least be positive and not be like sitting at zero and everything going forward. But in terms of like my concern about FG, I'm really more focused on the inflows and the capital deployed aspect of it. But either way, so very, very healthy. This gives me a good feeling about future FG as well. And then like kind of to look at that, let's see back up again. I already did this with the interest rate thing, but I think it's worth also, let's pull Blackstone up and compare it to Blackstone. Definitely gonna need it to have it on its own axis though, because their FG's just gone up a lot. But look at this, just over the history of FG. Let's go actually down to a weekly chart to get rid of some of the noise even. You can see they're pretty well correlated. The upward move is still higher for FG, and that's because they're a younger growing company with much higher growing revenues and stuff like that, but still very well correlated. And then you can see also within that the correlation then is breaking down in the most recent couple of months, as Blackstone is basically kind of like, market has kind of decided and realized that Blackstone has bottomed and then has started to come back up, whereas FG is not. And obviously that partially has to do with the issuance of stock on FG's part. So which is why whenever everyone kind of everyone, but one or two people asked me in the Discord about what I'm feeling about FG, and if I'm pessimistic about it or what my feelings are about that. That's why I'm really just not largely concerned. As far as I'm concerned, like if you compare it to every other related company or every other related metric, it really looks like there's a divergence between what's happening at FG and what you would expect FG to be doing based off of those related companies or related metrics, things like that. Which goes to show to me that the market just doesn't trust that share issuance yet. So as far as I'm concerned, that's really a very tangible, concrete thing that they can fix that will reward them in the market. Now, that is something that is tangible that they can fix, but doesn't necessarily mean it's super easy. I believe that it could be easy. All they really have to do is, I think, come out and announce some serious actual deployment of that capital. It's like they were given capital to deploy, now they need to deploy it. Much like in the same way as I was kind of talking about with Blackstone. It's like you can deploy all the capital you want, but if the realizations drop to zero, then the market starts to get real pessimistic about it. It's kind of a similar dynamic, except it's not realizations that's the aspect for it. It's more in FG's case, it's more like they received a significant inflow, and now their weight the deployment levels are too low. So that's kind of where we're at with that. Coming back over to my comments, some there. So speaking outside of the credit and insurance space, kind of just talking more specifically about their industry as all as a whole. In the call, they reference the IPO market really starting to wake up. They really speak to the IPO market having been pretty strong in the last quarter and really the last couple quarters compared to the last year. In fact, they specifically state that it's the strongest IPO market that they've seen since 2021. So that's pretty interesting to see on their part. They had a very big deal in the IPO market in Europe in the last quarter, as well as they said they saw a pretty strong level of sponsored activity, which includes SPAC. So a lot of people have talked about, a lot of the kind of bubbliness in the markets that seems to be coming back a little bit. While Blackstone themselves is basically saying that they're seeing a larger amount of interest in SPAC uh, 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 back utility usage of bringing certain companies to public. But they themselves are also saying that they have a number of other companies that are eyeing IPOs in the upcoming several quarters. So they believe the IPO market is definitely somewhat back, which would be very interesting to see. And then that speaks, I think, that also speaks to other financials like JP Morgan and the Morgan Stanleys of the world that will have a lot of fees related to that kind of business as well. So a strong IPO market could create a really a nice catalyst really for many aspects of the economy. It's like it's a little bit of um, a rolling ball. Once it starts to get going, it really just keeps going. Um, so another detail they mentioned in their comments in the call is that they mentioned that they manage specifically $250 billion on behalf of insurers within their insurance space, which I was really happy to hear that comment in the call because I in my 4 hour stream where I discussed FG to insane levels of degree, I know I talked about a lot of the metrics of Blackstone, and I was kind of like comparing their overall business relative to how their credit and insurance business does to get an idea of basically how beneficial I think FG is and how important FG is to them as a business, to get an idea of basically like um, uh, how strong their hand is basically in the relationship to a certain extent. But in the call, they were explicitly mentioned that they have, like I said, $250 billion in assets managed on behalf of insurers, which is a little bit more specific of a number to understand relative to just looking at their the total assets under management, the total AUMs. You can see right here, uh, total AUMs, credit and insurance, Q2 25 is $400 billion. So $400 billion across all of private credit and insurance. And then, comparing that, that's still the lion's share. You can see relative to private equity, which is a little bit less than 400 billion, and a little bit more than 300 billion for real estate. And then fee, different categories. This is total AUM, but then fee earning AUM, and then their perpetual capital AUM as well. Which is interesting to note that I think you can see that this is about 1/3 of their total AUM, and then it's uh, closer to a quarter of the fee earning AUMs, and then closer to 40% of the perpetual capital AUM. So what the difference between what that means is that this is AUMs that is being managed essentially largely on behalf of other people, and this is AUMs that's largely internal to a certain extent. It's a little bit more complicated than that terminology, but that's kind of like a really simplistic way to explain the difference between the two. This is kind of like retained earnings in a large sense to a certain extent. So you can see the 288 billion right here, and then they said 250 billion of that is the assets under management being managed by other private insurers. But you can see that they have a much larger percentage of the total amount of perpetual capital AUMs is associated with credit insurance, and that has largely to do with the retaining of the premiums for the need to be able to pay out against those insurers. So long way to say that insurance is clearly the heart of the capital base of their business, and it's also where they have the largest percentage of their actual retained capital. But even within that, then getting to kind of note on that, $250 billion being managed by poor private insurers, 50 billion or so is how much is um, is approximately how much they have managed for FG specifically. So I think in that 4 hour stream when I was talking about this, I was comparing FG's assets under management to their total assets under management, or even their fee earning assets under management. And so I think I pretty much had said like it was, oh, FG's probably like 10 to 15% of their business, of their insurance business, based off of that. But now that I know it's actually $250 billion for held on behalf of private insurers, that means that FG actually makes up 20% of their insurance business. So which is pretty cool, pretty cool. That means that FG actually has more power in that relationship than I previously thought. And also just a pretty significant weight for a small company. Like FG is only a few $1 billion market cap relative to some of the larger insurance players that they could be playing with. That's very interesting. And they also actually specifically on that note referenced that they brought in a new insurer into a relationship with them in the quarter, specifically in UK, the insurer Legal in General, which they refer to as LNG. But basically, they're looking to help them expand their, as and I quote, rapidly growing pension risk transfer and annuity businesses, targeting $20 billion for assets under management for them on the relationship over the next 5 years. So it just goes to show that like they're literally starting new relationships with other insurers in other markets outside the FG is not in, because this is a UK insurer and FG is focused on the United States. So this isn't competition to FG specifically, but it is a UK company doing exactly what FG does. That's a much more major insurer in the UK actually than FG is. And Blackstone's bringing on a new relationship with them. Not only are they starting a new relationship with them, but they're hoping to target a $20 billion relationship with them over the next 5 years. $20 billion over 5 years. That implies $4 billion of capital being deployed per year with this company. Um, you know, that I think that shows that they have plenty of healthy appetite as well as capacity to basically provide whatever business growth that FG could possibly want. So really, the ball's in FG's court as far as going out and getting that business. Is basically the long way of what I'm trying to say here. So very very good, very very good. Blackstone's earnings look great for them, but it looks, in my opinion, pretty solid as well for FG. And then, oh yeah, I'll like scroll down one more page here. Here it also shows they show their dry powder by each of these segments here. So they state themselves that credit and insurance has $47.5 billion of dry powder waiting and ready to go to put to work. So that, if you were to say that they took that 20 billion for legal in general out of this 47.5 billion, that would still leave them with 27.5 billion in dry powder. And obviously, like I said, they expect to do that over a 5 year period. So really, it's more like you would, like I said, assume maybe a $4 billion run rate of development for legal in general, and then that would be 4 billion taken out of this 4.75 billion. So even that only takes a dent out of the actual capacity that they really have available to them. So yeah, I had maybe one more comment I wanted to make on Blackstone. Oh, that's right. They also mentioned in the call at one point that over the last year and a half, they've placed credit at approximately 190 basis points over comparable, more liquid spreads within the market, which I thought was very interesting kind of point to point out. That seems very, very strong. That basically means that about 2 percentage points higher than a similar bond in a public market for their private credit basis, which gives it kind of an explicit understanding of just where those higher yields that FG is able to achieve comes from. So, like for example, I'm pretty sure FG currently has a yield on the average assets under management of close to around 5%, just kind of like over a course of several years on average, about like 5% or so. And so it's like if you maybe to come over here, we can see that um, 5 year treasury rate, which is kind of a pretty close to the duration we'd probably be talking about. It'd be 5 to 10 year, but about 4% or so. So 4% is the base rate on top of that. And then you could say BBB spread option index adjusted spread, which would be about 100 basis points. So 400 basis points, 100 basis points on top of that is 5%. And then approximately they're saying 2% on top of that is the spread that they're getting on top of that for similar illiquid assets. So that means about 200 basis points on top of that, which would get you to about 7%. So that means the raw yield on the actual loans that they are placing in their private credit and insurance business would be around 7% or so. And then also, FG then has to pay out close to 1% to Blackstone in order to achieve that. So that means over the last year and a half, based off of those comments from Blackstone, we should be able to expect potentially around 6% of a yield on average assets under management. Where, like I said, FG over the last like 4 to 5 years has really had closer to 5% on average. So I might be missing something there. Like it's possible I'm actually just missing an extra detail there, but that kind of implies that FG's yield on average assets under management could theoretically increase from 5% to around 6% over the next couple years. I like I said, I kind of wonder if I'm missing something there. That felt almost too good to be true based off that math. So I don't know. Maybe, like I said, there's also the potential that they don't distribute all of those spreads. Like I said, that's 190 basis points. The Blackstone says that they get over comparable assets, but that's on average probably. I don't know why FG would be getting the lower yield assets compared to other insurers, but you could argue that maybe it's not an even distribution across who gets what, and that maybe there's about a 1% difference caused there. Like I said, like, I don't know. I'm going to look deeper on that detail a little bit, but like I said, my initial thought around that when I heard that, and I kind of like I said, went and looked at the yields and looked at the math and was like, wait a minute. In my head, that implies that FG could theoretically have an increase in yield on assets to by about 20% over the next, like I said, year or two, from 5% to 6%. Which well, that's not, yeah, that's 20%. That's like a 20% increase, from 5% to 6%. So that would be like a 20% increase in profitability for the record. Well, not a 20% increase in profitability because you'd probably have um, excess costs beyond that as well. But even so, 10 to 15% increase in excess profitability beyond any increase in business and increase in to efficiencies to scale and cost, which would be the other avenue by which they were already going to have increase. This would be extra increase in earnings. But like I said, I'm going to look further into this into further detail and see if maybe there's like an extra 50 basis points to 100 basis points of something I'm forgetting there that would explain that away, or even 50 basis points of it. Because like even if it's not a 20% increase in the that yield, maybe it's a 10% increase in yield. That's still awesome, right? That would still be awesome. So I'm going to look further into that. Don't overly make too much of those comments. I wanted to share it because I thought it was very interesting and I'm curious about it. But I am going to definitely look further into that and probably get back to you guys in a couple weeks out of that. But interesting, very very interesting. But yeah, so that's pretty much all I have to say about Blackstone. Like I said, I'm very focused on that one, largely because of its relation to FG. But I do think paying attention to what's going on in private equity and private credit specifically is important to understand what's going on in the financial markets as a whole, just how complicated things are in our regulatory system. See back to some of my comments around JP Morgan. All right, so then last but not least, so the companies I wanted to talk a little bit about here today, my kind of little earnings season discussion is Newmont, the largest gold producers uh, globally, and a pretty big bellwether for the gold space. And that's another industry that I am pretty up to my gills in for anybody who's been paying close attention. First, let's take a look at what's been happening with gold over the last quarter. Basically, been flat for a quarter, like pretty much the whole quarter exactly. It's just been range bound between about 31.50 and about 34.50 or so. So about a $300 per ounce kind of range there. It's about 10%, give or take, range. So pretty tight range. Zoom out, look at it, right? Which I'll admit, like this behavior for the gold price has been very surprising for me personally, because I definitely think of gold as more likely to have extreme tops and then pretty significant retracements and then big bounce backs. Like I expect it to be volatile. So the fact that it had such a strong volatile run up and then it kind of leveled off so stably is very interesting to me. It's very, very, very interesting. I kind of expected it to pretty much wherever the top was. Like I didn't necessarily say it was going to be here. Like it wouldn't have surprised me if the top was another 100% higher, but wherever the top was, I kind of assumed that it would, within short order being like within 6 months, it would probably then drop by like 30% or something. Like that's the dynamic I kind of expected from the gold price. That's it, for it to either continue to parabolically shoot upward or to put in a top and come down significantly from wherever that top is. So the stability has just been fascinating to see. But that's been very interesting to then see what's going to happen with all the earnings of all the gold producers as a result of that. Because, well, frankly, all the gold producers have been experiencing significant amounts of uh, of negative sentiment relative to the gold market activity, partially because of, I think, basically everybody having that same expectation and dynamic with what's going to happen with the prices as a whole. So here I put the GDX on, which is the global large gold miners ETF over the last year. They're relatively in line, which is pretty good to see. But if we look on year to date, you can see that they've also been outperforming. What which has been good for that. But then if you zoom out to a 5 year period, you can see that they've been performing. You can see like, so really in the last year, the miners have been starting to kind of wake back up and really been like keeping in line with gold at least. And in the last 6 months, they've been doing better than gold, which is while gold's been putting in that base. So gold put in a base here, and then the miners continued upward actually a little bit. You can see it's not very strongly upward, but it's kind of been a little volatile, but it has still continued to drift up. So it's basically like the miners playing catch up to gold price as a whole. But there is a significant amount of catch up to do back over the 5 year period, and you can turn it into larger periods as well, and you can see similar. Really going back to the previous top where we had a huge retracement in the gold price, the miners came down dramatically, and it's just never really recovered since then. So like most people assume that like if you're going to be hitting the peak euphoria levels of the GDX, it's kind of assumed that it would have outperformed the total gain of gold since the previous level. Now that makes a lot of that assumption has a lot of implications in it. You're kind of assuming profitability and leverage and other things are all kind of similar in the GDX, which is definitely not the case. But in many ways, that's where the story gets even better, because in many ways, those metrics are better in the GDX now than they were back in 2012. Like the profitability is much better, and the leverage ratios on average are much better. So it's one of those things where a lot of people are wondering if we're going to get a crazy euphoric run gold miners specifically. So look at Newmont specifically. Newmont, see they've been spiking up pretty good. They had a pretty nice reaction to their actual earnings, which on relative to expectations was almost a 10% beat on the quarterly revenues and almost a 24% or 23% beat on the quarterly earnings, which goes to show kind of in line with what I'm saying there is that a lot of people are kind of using extremely conservative estimates in terms of what type of realized gold price that they're going to be able to achieve. And then a lot of people also have pretty conservative assumptions about what happens with their costs relative to that as well. So while AISC, which is all in sustaining costs, is a metric used to kind of measure the cost per ounce in gold mining on both a co-product, which means like gold by itself, and a byproduct basis, which means also selling any other metals that come along with the gold, including silver or copper, to basically net out for a lower cost here. So they're basically saying if we just sold gold and ignored the other metals that we collected, then our costs per ounce would be about 1,600 per ounce. And then if we sold other metals alongside it, we actually net it down to around $13, $16 per ounce. And again, compare that with the gold price of 3,300. The 3,300 relative to 1,600. So that's 400, 1,400, 1,700. That's $1,700 per ounce of profitability. And to be clear, ASIC is kind of like an operating margin. That's kind of like an operating cost margin. It's not exactly that. It's a non-GAAP measure, so it's not really exactly like anything, but like it's somewhat similar to an operating margin, but it's also kind of similar in some ways to a gross margin. So it's like it's kind of like I said, it's a little funny of a measure, but it's kind of a little bit in between it. So the reason why I say that is that yes, you have taxes, and you're still going to have capital expenditures, and there's going to be some other costs a little as well associated with that, interest costs as well. But for the most part, I mean, a lot of that ends up becoming just straight up profitability. So that's why it's like these gold miners, a lot of these gold miners are in position to basically rake in cash nonstop. And then comparing also their actual performance relative to their guidances, the 2025 full year guidance, they expect to produce 5.6 million ounces of gold. Within the quarter, they produced 1.5 million ounces of gold. So just within Q2, they have 1.5 million, which if you annualize that out, that gets you to 6 million ounces of gold for the year. So they're well above their target expectations in terms of production. And then they, as they mentioned here, that has a large part to do with gold grades at their Cadia and Penasquito operations. So higher gold grades is basically like how much gold you're getting per ton of ore that you milled. So that's a basically a high efficiency ratio that resulted in the high ability to produce stronger numbers. So that's gonna be pretty much just straight to the bottom line for them, which is pretty great. And then also they had an improvement on their ASIC relative to some of those expectations as well. Uh, in Q2, their ASIC co-produced ASIC was 1582 versus their expectation for the full year of 1620. So they're still about $38 per ounce under the cost expectations for the year, which is pretty steady throughout the year. So that shouldn't have a dramatic change. And they're also pretty significantly under their capital expenditures, both on the sustaining capital level as well as the development capital level for the full year. However, in their comments, they specifically note that they tend to weight their development capital towards the second half of the year, because they like to see what the first half production results were like in the first place. So that means that should probably actually get closer to their full year target by the end of the year, um, which is kind of like a gap filling kind of approach. But stronger production, very attributable to those higher yields, like they said. It could imply the second half results in lower capital spending, but that, like I said, it kind of depends a little bit. But if they had a very strong production in the first half, it kind of means that they theoretically don't need to have as much capital spend. So even though they are planning on having a higher level of capital spend in the second half, it's possible that they just don't end up doing so unless they want to completely outstrip their production target, which they could. If they did, that would just be an even higher increase in revenue for them in the short run. But that also could mean a higher amount of supply on the market, which could therefore lower prices too. So you kind of have to, it's a balancing act between those two factors, obviously. And then beyond that, one interesting thing I thought was very of note, it a direct quote from their call when they were asked about the potential for using excess capital for potential acquisitions or whether they're looking for further development in other areas. They said their focus is entirely internal. And this is the quote. They said their best use of capital is buyback of the company's stock. So, something shareholders always love to hear, that they literally believe that their best opportunity right now is literally just buyback. So uh, I'm not a Newmont shareholder, but I would be pretty happy if I heard that was the case. Another thing they commented on that they're still holding their Orla shares, their ORLA shares, which is another gold producer, which is one I do happen to hold. So they recently had a deal with Orla where they divested their Musselwhite operations in Ontario, Canada to Orla, and then Orla issued shares as part of the way they paid for that back to them. So or uh, Newmont has been doing this with several other companies. So they had several other company shares that they've been slowly kind of offloading from some of those other companies. But Orla shares they seem to be holding on to at least for the short term. So that's good at least for the float Orla. And then just goes to show that they have completed that divestment of that operation, which, like I said, I'm a shareholder in Orla partially based off of the divestment of that operation. So I personally thought it was actually worthwhile to invest specifically in that operation. And while Newmont has divested themselves from the Musselwhite operation, they do technically still hold interest in it because they have that significant shareholding. They were also asked about um, operating costs and inflation and what expectations they have for that, and they said that they are currently seeing it to be well within their expectations, even with the higher gold prices, and they don't expect major reversals on the ASIC margin due to catching up with costs. So that's one thing you tend to see with gold prices, that if gold prices shoot upward dramatically at a very fast pace, well, those ASIC costs, as I was just talking about, tend to only go up so quickly at a moment, but they do tend to track with the gold price nonetheless. So this is a huge margin between this price and the actual gold price, but that can get compressed over time as the gold price shoots up first, and then the ASIC starts to catch up. And they're basically saying that, like, in the meantime, while they have had increases in their ASIC, like I said, it's still below their target, and they're not expecting a major reversal in the ASIC margin, which goes to show that actually, like, the increases they're seeing is closer to the upper end of the speed at which they would expect those movements to go. all very good comments for profitability. In fact, the only major anomaly to their current profitability dynamics they say is worth noting is the fact that the increase in the gold price that we've seen would also increase royalty rates and taxes to the company at the end of the year. So like their current dynamic that they have in their cash flow, you can expect that to basically be similar in the second half, except for there being potentially a higher level of taxes and royalties due to the higher gold costs themselves. That's pretty much all my comments on Newmont. Like I said, a lot of very company specific stuff, but a lot of it is really just kind of getting into the nitty gritty of understanding like how gold companies operate. And I'm really like assuming that the dynamics in them as a whole, because they operate many different operations in many different competent uh, um, and many different continents across the whole globe, it kind of gives a good feel of like what global mining is experiencing as a whole globally. So it doesn't necessarily speak super specifically to my specific companies because those are all very specific to the operation at that mine in that specific corner of the world. So I'll have to kind of wait for the actual earnings to come out for my gold miners, which specifically includes Silver Corp, which is primarily a silver producer, but also has significant gold interest, but also New Gold, also Orla Mining, also Equinox Gold. So like those are my gold and really my precious metals exposures broadly. I'm not invested in Newmont specifically, but I and those companies all have their own very specific idiosyncratic risks and complications. But nonetheless, getting an idea of how I feel the gold market is going as a whole helps me to get an idea of what's going to happen with their earnings too. And on that front, so I mean, yeah, this looks very good for the gold market as a whole. And I'm also looking forward to when the Gold Hub, which is the other place I like to look to get an idea of like what's going on with gold markets broadly on a global basis. They themselves should release Q2 numbers at some point. Probably, I think it's like another 2 or 3 weeks until we tend to get the next quarter's information for this. So like we have Q1 information in terms of the actual global supply and demand numbers. So I'll be very much looking forward to that. Like I said, that's probably like I think 3 or so weeks away from being released, 3 if not 4 weeks away. But that'll be kind of like the next uh, close look inside the gold markets to get an idea of what I think's going on there. And really, the thing that I really want looking forward to, the thing that is most important in the kind of the biggest, most short term catalyst to understanding the gold markets right now is central bank buying. So really, this is the thing I want to know is what is the Q2 central bank buying numbers going to look like? But yeah, so we'll see. We'll see that in the future. But that's it. That's all my thoughts on Newmont. And with that, I mean that's all the companies I wanted to discuss here today. It took wow, so we streamed almost 2 hours, so that was a pretty healthy stream to cover that many companies. Like I said, I kind of feared running through all of those companies too quickly and not having much to say, which is kind of funny because I tend to almost always have lots to say about everything. But either way, hope that was valuable to you guys to get an idea. We took a little bit of a look at banking, a little bit of a look at private equity, a little bit of a look at housing, a little bit of a look at AI, at least in the context of advertising spending, and then also a bit of defense and a little bit of a look at the gold mining. So a little bit of a spread across different industries. A lot of it, like I said, focus on just kind of major economic bellwethers, but some of those companies had very close kind of like relationships or related aspects to my own companies, but none of my own companies. So that'll probably have to wait for 2 weeks from now when maybe we'll get a smattering of my own companies reporting. I can't really remember off the top of my head right now who's first. Let me pull that up. I do have a list, their site. All right. So what's coming next? New Gold reports tomorrow. Then we get PayPal and InMode and Generac and Millrose Properties for this week. That's what's coming up here in this next week for me is one gold miner, one e-commerce, one medical device, one industrial, and one real estate. And then next week after that, we'll be getting HSII, FG, Skyworks, FNF, and Silver Corp as well. So that will probably be what the kind of stuff we'll be covering in our next stream is whatever selection of those companies I feel like talking about the most. I probably won't cover all of them because, well, you see how long it took me to cover each of these companies in this stream. So we won't cover all of them. I'll probably pick like let's see. Like I said, I had 6 to do today, and we did almost 2 hours. So Let's maybe I'll probably try to pick more like 3 to 4, leave maybe a little bit more. We'll see what kind of stream length we end up with that. So we'll have to pick our favorites, whichever ones get the biggest reactions, and then we'll probably cover FG no matter what because well, it's FG. But yeah, Jeff there in the chat, hoping FG has a massive quarter. I too am hoping they have a massive quarter, but I'm trying to also keep my expectations low for this quarter. I don't necessarily have any real reason to believe that this quarter specifically should be some like crazy amazing quarter. Like I would love if it is, and it certainly could be. Like there's no reason it couldn't be, but there's also no specific reasons why it would be other than that they did that share issuance. But they did that share issuance before the last earnings, right? So we didn't see anything super crazy with the last earnings per se. Right? This was the share issuance, and then we had earnings soon after it. For sure, I'm pretty sure that was the timeline if I'm remembering everything correctly. So yeah, and then I brought up this page here while I was talking about that because this is another thing to be kind of on the outlook for, which I think is also 2 to 4 weeks away from coming out. But the Limra fact page, you have to choose the quarter it points to. But this is where I get those like insurance sales and annuity sales numbers for the quarter. But you can see Q2 is not out yet. It's probably going to be like 3 more weeks until this shows up as well. But I literally come to this page like every day, every weekday. I come to this page to see if it's out yet because I want to know how some of the annuity sales numbers. But soon enough, maybe my next stream will have them. But yeah, I think they were on pace for an amazing April IRRC. Yeah, definitely. Yeah. I feel like it'll be a good quarter. I just don't necessarily, I'm just kind of caveating my expectations on it because I don't want to like assume that we're going to get some big pop in the stock per se. Like, I'm sure the quarter will be fine. And I am optimistic that it could be more than fine, but I'm still definitely kind of thinking, just a couple quarters out in my mindset about FG. I'll give them time to do things right. I'm not in a huge rush about it. Um, yeah, they're pretty soft on earnings historically. Yeah, and then to be honest, it's like that comes down to their float, in my opinion. Like the nature of them being a subsidiary to 85% to FNF really just means that there's just such a limited amount of float, which it has its positives to the upside too, but it also has its negatives to the downside. It's like really once the kind of negative volume sentiment kind of builds in, it tends to create a much larger trend of momentum within that for a stock. So like the negative reaction over the course of this, like yes, we have the negative reaction to them issuing the shares, but a lot of that downward movement since then, I think, is just there not being enough volume in the market to really pick the stock back up, which means you really just need 1, 2, or 3 quarters of solid earnings to really kind of build that momentum back up. So it's one of those things where it's like it's just once the legs get cut out from under it, it just becomes hard for it to eventually pick back up. Which is basically, I think, similar problems that InMode has been having. Like I think it's kind of a similar situation there too, even though very very different industry and very different you know dynamics in terms of like why the stock got where it is. But anyway, that's pretty much going to be it for today. We talked about everything we planned to talk about. We went a little bit longer than maybe I was kind of hoping to. I generally try to stick closer to an hour and a half, but like I said, maybe I did 6 companies today, so maybe we'll try 4 or 5 or something and see where that ends up. But either way, very happy we got through everything. Happy to have had you with me here, Jeff. Cool to chat with you a little bit. I'll see you all next time.